Hi, my name is Paddy Hirsch. I'm a senior editor at Marketplace. And today I want to talk about leveraging and deleveraging. The reason for that is because a lot of people have talked about leverage as one of the biggest problems that's contributed to the financial crisis, and talk about the need for deleveraging. So let's first talk about what leverage actually is. Write it up on the board here. Leverage is actually just a really fancy word for borrowing. Okay, taking on more debt. The way leverage is usually described in companies or in funds or whatever is as a ratio. So say, for example, we have, and it's usually done at a ratio of, in companies' case, of debt to earnings, or debt to capital. All right, so this is the amount of debt that you have on your books in comparison to the amount of capital that you have on your books. And this is expressed as a ratio. Say, for example, it might be, in the case of a large company, 5 to 1. So in this case, a company has 5 times the amount of debt on its books than it actually earns in a year. Or in a fund's case, it has 5 times the amount of, it's borrowed 5 times more than it actually has capital on its balance sheet. So that's the way it's described as a ratio. And you've heard in some cases of funds and banks being levered as much as 25 to 1, or 20. This is also described as levered 25 times, and I think in some cases as much as 30 times. So clearly that looks like a lot of borrowing. But we should say at this point that leverage isn't necessarily a bad thing. I mean, leverage has done a great deal to promote the growth of an economy. And companies that can't borrow find it very difficult to grow. So, borrowing is a good thing, but people say too much borrowing can be a bad thing. And we're starting to see some of that now. So let's use a little metaphor, which is the metaphor of a balloon. So if you think of a balloon, which has obviously it has a skin, and inside the balloon goes air. And when you have, so if we compare the balloon to the economic system, it's the framework or the structure of the economic system is the skin of the balloon. So we blow this balloon up a little bit. In our economic system, we've got a market with stocks and bonds and all sorts of other things trading, and these things are they're working very well inside the balloon, and the balloon is very robust. You can beat it around a bit. It can take a lot of flack, and it retains its integrity, and it functions perfectly correctly. So then say we start to get leverage involved. We start borrowing things in order to grow. Say we borrow money in order to buy more equities or bonds or whatever they may be. Or if you're a company, we borrow money in order to buy another company or to expand our operations. So the economy starts to swell and gets bigger. But still, the integrity of the economy is good. We've used borrowing, we've used leverage to grow, but the economy is quite stable still. Once again, you can beat this thing around, and it retains its integrity, and it holds out well together. But now, say we start to over-leverage. Say we start to borrow vast amounts of money to buy, I don't know, mortgage-backed securities, collateralized loan obligations, collateralized bond obligations, CDOs. I'm not going to blow this up anymore because we can tell that it's getting a little bit tense. We've got an extremely strained system right now, and this is the situation that we found ourselves in once we kind of over-levered. So a simplification, obviously, but it meant that the system, the economy itself, was being strained at the seams by all of this leverage. And anybody who's done any tricks with a balloon knows that the more you blow the balloon up, and the more strained the fabric is, then the easier it is for us to pop the balloon. It just takes one little thing, and the whole thing goes. And that's the problem with leverage. The more that you borrow, the easier it is to wipe out everything that you have, and it doesn't take much to wipe you out completely. And that's the situation that we find ourselves in today. So what's the solution? Well, the solution is deleveraging. But deleveraging doesn't just mean paying money back, because once again we're talking about a ratio. So what we're trying to do is retain the integrity of the organization that we have, whether it be an economy or a company. So we've got the equation has two sides to it. So say, for example, we are levered at the rate of 25 to 1 in this situation here. So in order to delever, we have two choices. two ways, if you like, of letting air out of the balloon. The first way is to reduce the debt. So, the company or the organization goes out, the fund goes out, and it sells things in order to make money and pay off its debt. The other way, of course, is to deal with the other side of the equation, which is to raise your earnings or raise the amount of capital that you have on your balance sheet. And how do you do that? Well, again, perhaps you might borrow some more in order to expand, to make more money, to build up that side, so that you balance things out. So once the ratio starts to come down, say 20 to 1, 10 to 1, then you're starting to delever, because either your earnings or your capital base goes up, or the actual amount that you're borrowing goes down. And that's the situation that we are in right now. So if we have this economy which is strained and we're trying to deleverage, what we're trying to do is to improve the integrity of the economy itself, to make sure that the skin is more robust and can handle what's inside of it and is less strained. And what the Fed has been trying to do by adjusting interest rates is to try and keep a grip on the mouth of the balloon, if you like, on the exit for the economy. What it really wants to do is to let the air out little by little. Can you hear that hiss? Little by little. That's the ideal thing that we want. But of course that's not happening. The reason that's not happening, and what we're getting is this. The reason that we're getting that, and you're seeing that reflected in the wild swings in the stock market that we've been seeing recently, and in the bond market also, the reason is because people are trying to reduce their borrowings. And the way that they're doing that is by selling. Because they're not able to go out, because we're in a recession, they're not able to go out and make more money and raise more funds. Funds can't go out and raise more funds from people because nobody wants to invest. And it's very difficult in a recession to make more money from your operations because people are retreating and they aren't buying. So the only solution is to reduce this side of the equation, which means selling things in order to make money to pay off the debt. And the way that's happening, what's happening is that people are going out and they're selling vast amounts of of whatever they have in their portfolios, whether it be bonds or stocks or commodities or whatever it happens to be. The more that's sold, the more pressure that's put on the economy, or that's more pressure that's put on the markets. So you have that horrible sinking sound as more and more is squeezed out of the markets, and prices are driven down. So the deleveraging that we're seeing, some people are worried that it's turning into deflation. We're actually seeing a massive move of money out of the markets. Unless we're careful, unless the Fed and the Treasury and all of the other government agencies worldwide, that central banks that keep a grip on this outflow from the markets, unless they're very careful, what we're going to end up with is a completely deflated market and something that in the end is rather flaccid and useless. And that's the last thing they want to have. But of course it is not quite as bad as if we had this enormously inflated economy where everything was blown up beyond saving, and then you had that one little incident that pricked the bubble and exploded and left everybody very badly needing a drink.